Welcome to the deep dive. Today we're jumping into the Q1 FY26 earnings for Dhanuka Agritech Ltd. Now, this last quarter, April to June 2025, it was pretty tough for the whole Indian agrochemical sector. So the big question for you, our listener, is really how does a major player like Dhanuka handle a period like that? What do their results tell us about, their strength and where they're headed?
Yeah, it's a really critical question because companies like Dhanuka, they aren't just numbers on a page, are they? They're fundamental to India's agriculture. I
Hmm.
mean, their performance touches everything from our food security right down to farmer incomes across the country. So seeing how they navigate these rough patches, it gives you a real insight into the foundations of our food system.
Okay, so let's unpack the biggest hurdle first. Q1 FY26. It was all about the monsoon, wasn't it? The delayed and uneven onset. Sounds pretty serious for an agrochem company.
Oh, absolutely serious. A delayed or patchy monsoon directly messes with the timely sowing of Kharif crops. Think rice, maize, soybeans, the big ones that depend on those rains. If farmers can't plant on time, well, demand for inputs just drops, especially herbicides. You saw farmers really exercising caution. They were uncertain about the rain, plus they maybe didn't get great prices for last year's crop, so, why spend big on inputs? It's a huge gamble for them.
Right. And then just to make things more complicated, you had those weird rains in May, out of place rains, the report called them.
Yeah.
That actually forced resowing for crops like soybean and cotton in many areas. That's not just inconvenient, that must have caused chaos.
Total chaos. It created this mismatch, like you said, between the crop cycle and when farmers actually needed or bought inputs. Maybe they bought some stuff early, then had to replan, delaying other purchases or needing different things entirely. And add to that another problem. Elevated channel inventories. Basically, too much stock sitting with distributors in places like MP, Maharashtra, parts of Karnataka, Telangana.
Ah, so distributors already had stock, meaning Danuka couldn't sell as much into the channel.
Exactly. It dampens those primary sales. Though it's worth noting, the Nuke actually takes back unsold stock sometimes. That shows, good support for their partners. Helps manage that inventory pileup.
Okay, so delayed monsoon, resowing, high inventory. Sounds like a perfect storm. Yet, how did Danuka actually do financially in Q1? Did they manage to grow at all?
Surprisingly well, actually. Despite everything, the numbers were pretty robust. Revenue from operations hit ours, 528.29 crores. That's up 7% from 493.58 crores in Q1 last year.
7% growth in that environment. Quite something.
It is. And EBITDA, that's earnings before interest, taxes, depreciation, amortization, came in at ours, 83.19 crores. That's almost 16% growth from 71.72 crores.
Wow, 16% on EBITDA.
Yeah, and profit after tax, PT, was ours, 55.5 crores,
Oh.
up 13.5% from 48.89 crores.
Mm.
So for you listening, that 7% revenue growth, it isn't just a number. In such a tough quarter, it really points to resilience. Maybe the distribution network is really strong, or they have products farmers just couldn't skip.
And that 7% revenue growth the sources mentioned, it wasn't all just selling more stuff, right? Volume was 5%, but there was something else.
That's right. The other 2% came from a specific payment, about Rs 9 crore, from Bayer, India. It was related to a net economic benefit from a past deal.
Okay, so that 9 crore from Bayer that shows some financial maneuvering, maybe good partnership management.
Definitely. It shows they can leverage those strategic ties for immediate benefit. It's quite smart, especially when the market's tough. And if you look at where the revenue came from geographically in Q1, West India was the biggest chunk, 41%, the North at 31%, South 19%, and East 9%.
41% from the West. But weren't states like Maharashtra and MP, key Western states, hit hard by the monsoon issues?
They were, which makes that 41% figure even more interesting. That suggests Dhanuka has a really strong foothold there, or perhaps they actually gained some market share while others struggled more.
Fascinating. And the product mix, what sold well?
Herbicides were the big category, making up 50% of turnover. Then insecticides at 23%. Others, that includes technicals, plant growth regulators, bulk sales were 16%, and fungicides at 11%.
50% herbicides, but wasn't that the category most affected by the planting delays?
Exactly. That's what makes the overall growth even more impressive. It means either other categories really pulled their weight or specific herbicide products, maybe for specific crops or regions, held up much better than the average.
So, given they navigated Q1 relatively well, what's the bigger picture? What's their strategy beyond just weathering these storms?
Well, they really emphasize their identity around innovation and collaboration.
Yeah.
They talk about a key focus on introduction of novel chemistries. They back this up with 2 NABL-accredited R&D labs, world-class apparently, and these important tie-ups with 10 global agrochem leaders from Japan, the US, Europe.
Right, bringing in that global tech. We saw that with new launches like Dinkar, right? A new herbicide for paddy from Hoko Chemical in Japan.
Yeah, Dinkar is a 9,3 herbicide, which basically signals it's a new molecule type. It got an encouraging response, especially down south.
And Melody Duo, that was the one acquired from Bayer last year.
Correct. Melody Duo contributed around Arzine crores, but that was royalty income. It shows they're also leveraging acquisitions cleverly. These new products are significant. Dinkar shows innovation in paddy, a huge crop. Melody Duo shows a smart way to get high-margin revenue from proven tech.
But their innovation turnover index, the ITI, actually went down a bit, from 19% to about 13.4%. Why was that?
Good point. The main reason was timing. They only launched one major new molecule, Dinkar, this quarter. In Q1 last year, they had bigger contributions still flowing from older launches, like Tornado, which came out 3 years ago. So it's more about the launch cycle than, a drying up of the pipeline.
Okay, that makes sense. And what about their established products, the workhorses like Targa Super and Sumpra?
Still performing well. Targa Super is a leader for soybean and cotton, and now they're seeing potential in onion and black gram too. Sumpra, another herbicide, is doing really well in sugarcane and maize. These big brands are crucial, and it's interesting they mentioned having around 10 brands now that do over 50 or 100 crores in annual revenue. 5 years ago, it was maybe just 2 or 3.
That shows real brand building success over time.
Definitely. Deep market penetration.
Okay, shifting gears from products to production, the Dahej manufacturing plant. How's that fitting into the strategy?
Dahe is key. They expect it to run at about 60% capacity this year, bringing in maybe 65 crores in revenue. Right now, it makes one product, the Fenthin. They plan to add a second one in the second half of the year. But the really interesting bit, they're in talks for CDMO contracts, contract development and manufacturing, using their plant to make stuff for other companies. That could be a whole new business line.
Ah, CDMO, that's a big potential growth area. So expanding manufacturing capability. Are they also looking outwards beyond India?
Yes, exports are definitely part of the plan. They've applied for registrations in about 6 or 7 more countries for products made at Dahej. The Melody range, for example, is already registered in over 25 countries. So they're building that global presence.
And quickly, what about the products they don't make themselves, the traded category?
Right, the ones they source from others. That includes about 7 key brands, things like Tornado, Douche, Nav, and Largo. It complements their own manufacturing.
Okay, so looking forward now, what's the vibe from management? What's the outlook? What should you, our listener, expect next?
Well, they're definitely reviving optimism. A lot of that is pinned on the weather forecast. The IMD, the India Meteorological Department, is predicting an above-normal monsoon for the whole Kharif season. That's got people talking about potentially a new record in food grain production.
And better rains mean better demand for Dhanuka, right?
Exactly. More planting, more crop care needed. And they're already seeing signs of recovery in Q2. July consumption was reportedly better. Widespread rains have led to a significant jump in fungicide consumption. Insecticides are expected to follow. Paddy acreage should also go up, boosting demand there too. So management's sticking to their goal of double-digit growth in revenue for the full year.
Double-digit growth, that's confident after Q1. What about profitability, the margins?
They're a bit more cautious. They expect around 100 basis point decline in the full year EBITDA margin.
A full percentage point drop. Why if revenues are growing?
They gave a few reasons. 1, the gross margin in Q1 itself was a bit lower. 2, there was a ban on a biofertilizer molecule that was apparently highly profitable for them. And 3, the cost of technicals, the raw ingredients, isn't falling anymore like it was last year. That trend stopped, taking away a cost advantage they had.
So cost pressures are building a bit, but they expect pricing to hold up.
Yes, they expect stable to northward pricing soon, basically because demand should pick up strongly with the good rainfall.
And new products. Anything else coming this year besides Dinkar and Melody Duo?
Yep. They're planning to launch Kenzan, a fungicide for grapes and potatoes from Nissan Japan, plus at least 2 more Me Too products, generics, essentially.
Okay. And shareholder returns, still a focus.
Seems so. They reiterated the final dividend Rs. 2 per share, 100% payout, and mentioned the share buyback they just did. 5 lakh shares at Rs. 2,000 each, costing Rs. 100 crores.
Got it. There was also a quick note about an investment write-down, something about a drone company.
Yeah, Iotech World Aviation. They marked down their investment value from 31 cores to 22.5 cores, just the standard mark-to-market accounting adjustment reflecting its current value, not operational news as such.
Okay, and one last thing globally, what's happening with those technical prices, the raw materials?
The general trend seems to be inching upwards or flat. Chinese suppliers still have a lot of capacity, keeping prices low for many things, but demand in big markets like the US, Latin America, and Europe seems to have picked up. So maybe the bottom has been reached for some inputs.
Oh, and one final point for management. They felt their Q1 numbers looked maybe softer compared to some rivals, but they argued it's because Dhanuka had a much better and wider base last year. Their Q1 FY25 was stronger, making the comparison tougher this year. Context matters.
Right, always important context. Okay, so let's try and wrap this up, this deep dive into Dhanuka Agritech's Q1 FY26. What we've really seen is a company facing pretty serious headwinds, the monsoon, inventory issues, but still managing to post growth. It points to, well, a certain adeptness, smart product focus, managing those partnerships, and a clear commitment to R&D and shareholder value. For you, the listener, it paints a picture of resilience in a really vital sector.
Absolutely. And it leaves us with a bigger thought, doesn't it? In a world where climate variability seems to be increasing, how much will success for these agrochemical companies depend on their ability to forecast better, to pivot their product mix faster, to manage inventories incredibly tightly? Their skill in doing that won't just define their own future, but it will also be critical for, securing global food supplies. It's a challenge that goes way beyond just one quarter's results.